Hello, everybody. Welcome to my intermediate accounting solution walkthrough video for exercise 16-1. This is from the intermediate accounting textbook. Authors are Don Kiso, Jerry Weinget, and Terry Warfield. The question used in the presentation is copyright 2019 by John Wiley and Sons. All rights are reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. The solution and presentation is copyright 2019 to 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of Bennett Tchaikovsky and not the authors of the textbook or of Wiley. Okay, so take number 2. Okay, so Grand Corporation issued $20 million of par value, 10% convertible bonds at 99. If the bonds had not been convertible, the banker estimates they would have been sold at 95. Well, because there's not an additional attached amount, we don't really want to look at that 95. It just tells us that there was a value to the conversion feature. So when I look at this, my cash being received is going to be 20 million at 99 or times 0.99. When I record a bond, I always record it at the face value, which is going to be 20 million. And then my difference over here is going to be my discount on bonds payable. Okay, so that takes care of the first part. So again, unlike this next one, which we're going to be doing over here, we're going to be assigning a separate value over here to the warrants. So we've got Hoosier Company issued 20 million of par value, 10% bonds at 98. One detachable stock purchase warrant was issued with each, basically was issued with each $100 par value bond. At the time of the issuance, the warrants were selling for $4. Okay. We can approach this a couple different ways, right? But I do know that this bond is being issued at a discount. Why is it going to be at a discount? Because if it's being issued at 98, the amount of cash that I'm going to receive, and this also includes the warrants, is going to be 20 million at 98 or 19,600,000. Okay. I also know, because it's being issued for less than face value, I'm going to have a discount on bonds payable. And I also know that I'm always going to record bond payable at the face value. But what I'm going to do over here, though, as well, is I'm going to have additional paid-in capital stock warrants. Okay. And if they're detachable, it means that the investors can essentially take those and essentially go out and sell the warrants. So over here, my bonds were being issued for 20 million. And it was, so one detachable stock purchase warrant was issued with each $100 par value bond. So my par value per bond at $100, what does this mean? Well, what this means is the total number of bonds that I actually issued were going to be 200,000. Excuse me, the total warrants issued. Right, so right over here, sorry, let me just rephrase this. One detachable stock purchase warrant was issued with each $100 part. Yeah, so basically we issued 200,000. So I issued 200,000 bonds. And then over here, this is going to be, so if I've issued 200,000 bonds, it's going to be one stock warrant per bond or 200,000 stock warrants. Okay, so now what I need to go through and figure out is what is the value I want to go ahead and assign to those warrants. So right over here, it tells me that it has a value of, at the time of the issuance, the warrants were selling for 4. So the total amount I'm going to hit to additional paid-in capital stock warrants is going to be $800,000. Okay, so now When I come over here for my discount on bonds payable, it's not just the difference between the cash that I received and then the bond payable, because there is a value to these stock warrants. So my discount on bonds payable is going to be the bond payable plus the stock warrants minus the cash, or 1.2 million. So that's how I'm going to go through and record this particular one. So again, I'm issuing a bond at a discount. How did I know I was issuing a bond at a discount? When you see 98 or 99, it basically means at 98% or 99%. So over here, when I go through and do this, I know that it's at a discount. When I have a bond being issued at a discount, I am always crediting bonds payable, debiting discount, debiting cash. But here, because I have a detachable stock warrant, I have to go through and assign some value to that as well. Okay, so let's go over here to our last example, or part 3 in this question. So suppose Ciprocor called its convertible debt in 2020. Assume the following related to the transactions. The 11% $10 million par value bonds were converted into 1 million shares of $1 par value common stock on July 1st. On July 1st, there was 55,000 of unamortized discount applicable to the bonds. In addition, the company paid 75,000 to bondholders to induce conversion of all the bonds. Okay, so when we have a cash payment for conversion, this is kind of the way I like to go through and handle this. So what I would go through and do is let's look at where we are. So we've got a discount on bonds payable. We have bonds payable. So my bonds payable is at 10 million. I had a discount of 55,000. Okay, so right over here, when I pay that debt conversion expense, when I pay that 75 grand, I'm going to debit debt conversion expense. I'm going to credit cash for the 75,000. I like to break this out separately from the rest of the transaction just to kind of simplify it, because this is not going to have any kind of play into how the stock's being, determined. Now, when I convert the bond, right, I would want to go through and figure out any type of accrued interest, but there is really doesn't look like it's here. So over here, what I'm going to go ahead and do is I'm going to debit bonds payable, and this is going to be on 7/1/20. And then I also have to get rid of that discount. So what I'm going to do is I'm going to credit discount on bonds payable for 55,000. At the same time, what I'm going to be doing over here is the next part of this is I'm going to be crediting common stock at par. And how do I figure out the common stock at par? Basically, what tells me where the 10 million bonds were converted into 1 million shares of dollar par value common stock. So it's dollar par value common stock is still too high, but we'll leave it alone for now. So this is going to be 1 million shares times $1 par value per share. And now to balance this equation out, I'm going to have additional paid in capital common stock. This is going to be the 10 million minus the 55 minus the million. So that's how I go through and do the conversion. Now note, I put this separate because to me, it's just makes it like a little bit easier. Is just, I want to separate that because that debt conversion expense is going to be separate from the rest of the transaction. So that takes us through the third part over here. And so I want to thank you all for coming and watching this video here today. Also want to thank Wiley. Please don't forget to like and subscribe. If you're looking for other solutions, feel free to ask for them in the comments. Have a great day. Looking forward to seeing you on the next video. Have a good one.